Hello, I'm Annabel Brodie-Smith. I'm the Communications Director of the Association of Investment Companies. And earlier today, I was talking to Alastair Laing, the co-manager of Capital Gearing Trusts in our flexible investment sector, which we launched in January.
Capital Gearing Trust is an investment trust that has an underlying multi-asset portfolio. So we invest across equities, bonds and commodities. The portfolio is designed in principle to represent the entirety of an investor's portfolio. And the investor that we'd have in mind would be relatively conservative, they would have a long-term mindset, and they would have an aversion to capital loss in any given year. What I think is different, there are a number of multi-asset or absolute return products that offer similar long-only absolute return mandates. What's different about Capital Gearing Trust is all of our equity exposure is expressed through other investment trusts. So we are an investment trust ourselves, but we also invest into other investment trusts. And we do that for two reasons. Firstly, as I hope a number of people watching this video will know and understand, investment trusts have an exceptional long-run track record of attracting high-quality managers running interesting portfolios that have over long periods of time delivered very good returns. So that's a nice backdrop to our portfolio. But there are also opportunities within investment trusts that offer greater value entry points into certain asset classes, particularly unloved asset classes, because on occasions the investment trusts themselves will go to discount and offer an interesting time for us to invest into those asset classes. We would say now is a good time. There's been a long bull market in equities, at least as we analyse the market. Equity prices are very high. By that, I mean that they're at levels which historically have delivered poor returns over a 7 to 10 year period. Of course, no one knows how that will unfold. The equity markets could continue to go up for a number of years, but if the equity markets go up any more, it's gains lent rather than gains bought. I think it's only a matter of time before they come back down again. Our portfolio has been defensive for a long time if you consider a low allocation to equity as being defensive. However, I would say that our portfolio is as defensive as it has ever been. We have a low allocation to equities, high allocation to fixed income, but those fixed income instruments are short duration. That means that they have a relatively low sensitivity to a change in interest rate environment. So they are quite close to cash-like instruments. So we are nervous of both the equity market and the bond market. In a sense, we believe that all asset prices are elevated at the same time. Our equity exposure is around 30%, but substantial portions of that equity exposure are made up of fairly low beta or low volatility equities, because we are very nervous of equity market valuations, and we think in general equities are highly priced. There's no way within a multi-asset portfolio or the way we run it anyhow, we would ever have a zero weighting to equities, but it would be difficult within our portfolios to have a weighting that was any lower than it is today. The equity market and the bond market, as they're priced today, will deliver low returns. That is a very difficult thing for investors. It's a very difficult position, for example, for pension funds or for individual investors who are saving for their own pension and their own future. However, the most important thing for us as fund managers is to recognise the situation that prevails and not to reach for returns that also involve exposing our investors to excessive levels of risk. So we consider that if By long term, you mean 7 to 10 years, that over that horizon, both equities and bonds will deliver poor results, maybe zero real return. However, we see our job as preserving capital after income, fees and taxes, because a zero real return never happens in a straight line. In capital markets, what that means is you'll have ups and downs, and there will be times within that period that there will be great buying opportunities. And we have to make sure that we have the dry powder set aside today to exploit the opportunities when they occur.
Well, it's very interesting to hear from Alastair Laing, because Capital Gearing is an investment company which gains its equity exposure from investing in other investment companies. But it has a multi-asset approach, investing in a range of different asset classes. Thanks very much for watching today.